Hold on just a second, everyone. We have to unmute Neff. We'll just hold on a second and we'll get rolling here. Just get us fired up.
Okay, I think we're good to go.
All right, good. All right, perfect. And Beth, just so that you see, do you see the slides?
Yes, I do.
Perfect. All right, Beth. So thanks for joining me today.
My pleasure.
You're welcome. So Beth is in our Royal Oak office, and I am in our office in Mishawaka, Indiana. And so we're going to jump into this with the Secure Act. Again, if you want to submit a question, you can do so by clicking that and submitting a question there as we go along. So the Secure Act. The Secure Act was the biggest retirement piece of legislation in more than a decade. There's obviously a lot of components that are within the Secure Act. We're really not going to touch much on components that would affect business owners, small business owners. There's a lot of pieces there as it relates to maybe some more opportunities as it relates to retirement plans and other things. We're going to more focus on individual and how this might affect you. The Secure Act was for setting every community up for retirement enhancement. It was interesting last year that about mid-year, we really thought that we would have really a passage of the Secure Act fairly quickly in the middle of the year. It got through the House by 204 to 4. We really thought that it was going to happen last year, and then other things got put on the back burner. So other things happened and it got pushed aside. And then at the end of the year, it really, it got pushed in and signed, and here we go. So it was effective January 1st of 2020. So let me see if I can move the slides here. So if we take a look at the next slide, let's talk first about IRA contributions. So one of the things in the old world that you could not do with a traditional IRA contribution. So a traditional IRA would be one that you would typically deduct off your taxes, is if you were 70 and a half, you could not contribute to a traditional IRA and deduct it. So now, with the effective January 1st, you can in fact, after 70 and a half, continue to contribute to a traditional IRA and deduct it. There must be earned income. So if you earn $4,000 of earned income for the year, you could do a traditional IRA of $4,000. The limit over the age of 50 is $7,000 for 2019 and 2020. So if you are part-time working right now, it may be advantageous for you to look at maybe doing a traditional IRA. So I know we run across a lot of clients that work after the age of 70 and a half. And as I said, there must be earned income. The other thing to don't forget about is that if you work and maybe your spouse does not have earned income, there still may be opportunity for spousal contributions. So if you're of similar age, maybe you can do your own contribution and you can do a spousal contribution as well. Beth, do you have anything to add on that?
I do. I have a couple of things, and just examples. I ran into a situation for the first time this week or end of last week with regard to the Secure Act and this idea of contributing after the age of 70 and a half. I have a lovely client who retired on December 31st, and in her words, immediately failed retirement because she accepted an interim position where she's going to be working for the coming year. So she was back to work by January 7th or so. And here's a case where she saved everything that she needs. She was ready to move into retirement, and now she has this extra income coming in, which we'll use to put into a traditional IRA for her. And she herself she'll be 72 here in the next few months. So prior to January 1, she would not have been able to save that money. Going forward, she will be. And with the Secure Act, there is now there is no maximum age for making contributions to an IRA. So whether you're 72 or 82, that's available to you. And I can think of this working for folks who are continuing to work or doing some contract work or expert witness sort of things, that would come into play for them. So I think that's a great way. And remember that it's an odd situation where if you are already taking required minimum distribution, so you're already over the age of 70 and a half, you can find yourself in an odd place where you have to take money out to meet your required minimum distributions, but at the same time, you can now make an IRA contribution. And I think another thing to think about here is we're talking about traditional IRAs, but Roth IRAs come into play too. And for 2020, if you're married filing a joint return, then you can make a Roth contribution with income up to $196,000. It begins to fade out at the end of $206,000 of earned income. So I think that this is a great opportunity for people to continue to save and use IRAs in the traditional sense to reduce their taxable income, is how I've seen it come into play already.
Yeah, I think those are great points, Beth. And I think about, a couple of years ago, there were the tax law changes, and now we have the Secure Act. And so there were tax law changes, and there were a lot of changes there, and taking away things that maybe you could itemize, deduct, and so forth. But they haven't taken away strategy savings or strategies as it relates to what you're talking about, whether it's a traditional or a Roth. And of course, now it's expanded past 70 and a half.
Exactly.
So keep that in mind. The other thing, as you said, Beth, the income limits for Roth IRAs, a lot of folks think that they're out of the income limit, and it's actually quite nice high where you can still contribute to a Roth.
Right, it's a healthy income level. And then to your point, Eric, with the pre-tax IRAs, I think about people, just an example of with the tax law changes that went into place in 2018, where they're finding that they're capped at the $10,000 now for property taxes and interest on mortgages, where folks counted on being able to write off those expenses to help reduce their taxable income. Well, the ability, didn't take away the ability to save. So maximizing 401k contributions, if that's appropriate, or using pre-tax IRAs to reduce taxable income, if that's appropriate, are ways to maybe make up a little bit of the write-offs that were lost with the 2018 tax law changes.
Yeah, great point. Okay, so let's kind of move on to the next slide and talk about some of the provisions that are not as much tied to retirement, but Beth and I wanted to make sure that we just bring these up. The first one is that you can have penalty-free distributions up to $5,000 for a qualified birth or adoption. So if you're in a position that maybe you're going to have an adoption in the future, and you want to take a distribution out of your retirement plan, this is now allowed to do this and not have penalties assessed. Obviously, penalties assessed on retirement plans, typically if you take money out prior to 59 and a half, then you could be subject to a penalty. There are some nuances with that, but that's basic. Basically, we look at it as a penalty that's assessed. So there's that available. The other one that we thought was kind of interesting was 529 plans, which I know many grandparents have those established for grandchildren, and many parents have it established for their children. They now can be used for apprenticeships. So you think about, well, I don't know if I want to put this money in because maybe they'll go to a trade school or go through an apprentice program. So that's available, as well as paying off student loans. So you could actually look at strategies around what makes sense. Does a 529 plan make sense? And many 529 plans offer a state tax credit, which is a great thing. But Beth, maybe you talk about the time value of money there, and something to think about on the.
I think these first two non-retirement provisions really lend themselves to planning and strategizing. With the 529 plans, if we think about time value of money and the opportunity, the potential for growth and income, could it make sense to leave 529 money in place as you apply for financial aid? If you, through a financial aid package, receive the more desirable pieces of it, which to me means the subsidized student loans, could it be possible to say, all right, we're going to take those subsidized student loans, which delay payment until after you're finished with school, leave the 529 money in place to potentially grow or earn income and dividends. And then when the student is finished with school, then use that 529 money up to $10,000 per year to pay off those student loans. So, basically, is there an opportunity to use somebody else's money for a period of time to fund school while your money has the potential to continue to grow? So I think that is a really strong planning opportunity to consider if it's appropriate for the situation. I don't know that it is as desirable to go with that strategy if you have unsubsidized loans or using one of the parental loans to undergraduate students. But something to consider if you've got 529 money and are applying for financial aid. And then with regard to the penalty-free distribution for a qualified birth or adoption, again, a planning opportunity here. What came to mind for me when I saw this is that this penalty-free distribution it adds to the lineup that's already there, being able to take money out of a qualified plan without penalty for the purchase of a first home or to pay direct tuition payment to a school or for hardship withdrawal. So it kind of adds to that list of already 5 or 6 things. And I know that paternity rules are becoming more extensive and flexible, but for me, this is an opportunity where maybe a family is having a new baby and there's only a short amount of maternity leave provided, or maternity leave and income during that time is limited to shorter long-term disability, that here's an opportunity to maybe bridge that gap of, you're taking money from retirement to use it currently, but that could help a family with their planning of how long somebody might be staying home with a child before they have to go back to work and have that paycheck coming back in again.
Yeah.
So I think there are 2 really good opportunities there. And then this third piece, with regard to the provisions for healthcare, I had to go back and check on this one. I have to be honest, because I thought, wait a second, I didn't know that it was going up to 10%. But with the tax law changes that were done in 2018, the 7.5% of adjusted gross income for potential write-off of medical expenses was due to go up to 10%. So it would made it more difficult to have that deduction for healthcare expenses. The Secure Act extends that. So the moving from 7.5% to 10% was supposed to take place at the end of 2018. Well, now it will be in place for 2019 and 2020 before the deduction goes up to 10% of adjustment.
Yeah, so it was kind of an interesting bolt-on that they got there. The other thing I'll bring up that's not really, it's somewhat tied, but on the 529 plans, and it's often overlooked, is, if you have multiple beneficiaries, so if you have multiple grandchildren, and maybe one of them gets uneven in their 529 plan for whatever reason, contributions and usage and so forth, you have the ability to change beneficiaries on those 529 plans to kind of even it out as well. So you could switch if one grandchild has more student loans than another, you could switch it over and then it could be used to repay some of the loans. Yeah. So I think that's some
Let's tack one more thing on there before we flip pages with regard to the 529 plans. Here at Hilltop, Eric and I, as you know, as clients, we're always encouraging people to save and save where you can and take advantage of tax efficient plans. Well, one of the things that I've heard, and Eric touched on this too, and just reiterate it, is that people don't want to use a 529 plan because of concern that their child or their grandchild isn't interested in a traditional go to college or go to community college after high school, that they're more interested in the trades. And here in the Detroit area, working in the trades is important with all the growth that we're having, and there's a shortage of people working in the trades. Well, now being able to utilize 529 assets for trade schools and apprenticeships is another reason to save, because there's less worry about money going unused within there. So another planning point with regard to college and post-high school education, I think is really a strong opportunity.
Great point. All right, let's move on. So let's talk about some retirement plan changes. As I mentioned in the opening, there are some other changes as it relates to retirement plans, particularly business owners. But we wanted to touch on a couple things. Number one is the provision now will allow part-time employees to participate in company retirement plans. Before it was full-time employees. And so it opens it up, we think, to some more opportunity. And, we always advocate that if there's free money in there, if they're matching funds, you definitely want to at least save up to the matching, if not more. And this, I think, will allow some part-time employees now to be able to get matching funds. So I think that's a piece of it that you want to think about. The other thing that that came about was the provision now allows for employers to offer annuities inside their 401k plans. And you can see there that we have a little caveat that says you just want to be cautious of the choice and consider the options. The reasoning behind the annuities is that with annuities, you can have these living benefit, kind of guaranteed benefits to use sometime down the road. The thought is that people are living longer and, are they going to run out of money? And with kind of a guaranteed benefit, it takes the risk of the market and things of that out of it. As we see it, that it may work for certain folks. What the it needs to be cautious in the sense of the actual costs of that annuity. So, if somebody signs up and puts an annuity in their plan and they've got 15 years until retirement, well, it's what is the overall internal cost for those 15 years prior to retirement? And how does that affect your return? It could affect your return quite substantially over time versus when you retire, then maybe you look at the option of then utilizing one of these annuities that have living guaranteed benefits versus holding on to that account for many years and paying the cost for really something that you have not used. And so this one we're cautious. We look at this as taking a look at it, taking a deep dive look of what annuity is going to be offered. Obviously, since this is a new January 1st, 2020 provision, I'm sure that the annuity companies as well as the 401k providers are starting to look at what that looks like. But I think that it needs to be a discussion with your advisor to make sure that, okay, let's truly understand what this is and the costs there. So Beth, would you have anything to add there?
I do. I think I'd just like to add a quick bullet pointed list of we say, look at the costs, consider all of those costs. So the costs that you want to look at or see if you can find the information on are within a variable annuity, which we would assume would be offered, the internal costs of the underlying mutual funds inside of that contract, the expense ratios. Does that annuity contract have a mortality and expense fee associated with it? The cost of the rider, if to Eric's point, it's an annuity that has a living benefit rider on it, what is the cost of that rider? And then I think we talked about this in the Hilltop Advisor meeting this week, and we think this is where annuity companies will be developing new products is with annuities, we generally have to consider surrender charges. So if you start and you're working for a company and you choose to use an annuity within the 401k plan, but then you leave that company and want to transfer your 401k to an IRA or another plan, what are the surrender charges, which are a standard component of annuity? So we think all of those costs are the ones that I would look for if an annuity were offered within the 401k. And a couple of those, we as a team were discussing that we think the annuity companies will developing new products around annuities that will go inside of 401ks, and surrender charges could be some component of that. So that's what I would offer as far as look at the costs. Those are the costs that I would consider.
Yeah, and we obviously are focusing on this from a cost perspective, but the cost in these, as some I know clients know, and working with your advisor and working with us over the years, is determining what those costs are. You got to do some digging. So there's a lot of digging that you need to go through. So, okay, let's move on to the next slide. Okay. So these are probably some that I know affect a lot of folks on the webinar today. Number one is required minimum distributions moved from 70.5 to 72. So if you were 70.5 last year and you had to take a required distribution, you're under the old rules. So you can't now skip and go to 72. And however, if you were not 70.5, so I just had a client this week actually that's turning 70.5 this year. She now can wait until age 72. Pretty straightforward and simple. Now, I asked myself, why did they do that? Why did they push really trillions of dollars from 70.5 to 72 so people don't have to withdraw? Because remember, these are funds, these are monies that have not been taxed. So why would they move it another 18 months? Do they not want tax money? Do they not want it sooner? Certainly they do. So what they've done is they've taken out the stretch IRA. So let me just kind of go through this. Beth and I will kind of explain it. So what happens with an IRA, as most of you know probably in working with us over the years, is when you pass away, and if you are married, have a spouse, you can pass that IRA on to the spouse. And the spouse really has a couple choices. They can leave it in the deceased spouse's name and take it out based on a life expectancy, or they can roll it to their own. And that really just depends on the situation, what's best. Once you move on to the next generation, so if I have an IRA and I don't have a spouse, my spouse is deceased, and I pass away, my IRA goes on to my children, okay? In the old world, prior to 12/31/2019, my children could choose to take the IRA in a lump sum, or they could choose to spread it out over life expectancy. So there was a life expectancy table that is a published table, and so they could spread it out over life expectancy. Remember, this is money that has not been taxed. So if they take it in a lump sum and it has any size to it, it's going to show up as taxable income in that year. And a lot of beneficiaries are still working, so they already have taxable income, and it doesn't take a whole lot to push a tax bracket up to the 35–40% range. If they stretch it out over life expectancy, then it's like taking a pension. And I know Beth, myself, and the other advisors have done many, many illustrations over the years and showing beneficiaries the differences and saying that, look, if you just take this as a pension, you'll have a pension for a long time. Well, the new act says can't do that. No more. There are no more stretch IRAs. So you certainly can pass to your spouse and they can put it in their IRA, but you cannot do a stretch IRA to a beneficiary. There are a few exceptions, minor children and some other exceptions, but for the most part, you cannot stretch it out. There is even a trust, and so I know we have done these with clients before where it made sense that the IRA money would pay to a trust, and the trust would pay out every year. So basically, the client or the holder of the IRA wanted to make sure that the beneficiaries took the annual payment versus taking it all in one lump sum. So the new rule is no more stretch. Those provisions as it relates to stretch IRA trusts and so forth are really no good now. And they're really trying to determine, is there anything there that they can actually work from? So basically what has to happen now is when a non-spouse beneficiary inherits the money, it has to be distributed within 10 years. That's it. So there is no even, they don't have to take it even. They can take it out a little bit the first year, nothing for 5 years, and take out the whole amount. It just has to be exhausted for in 10 years. Now, with trillions of dollars and the way people are saving money in these accounts, this may be significant. So if we go to the next slide, we'll show you what we've put together here as an example. So this example looks at a balance of an inherited IRA of $500,000, and we're assuming a return of 7% on that account. The beneficiary is age 55. If you look at the right-hand side shows the old rules. So the old rules were, again, you could take that $500,000 and you could do it on a life expectancy. You're not penalized any penalties, but you pay taxes on the distributions, and you can see that within over a 10-year period, this beneficiary would have withdrawn $250,000, and the balance in the IRA would have been $697,000. On the left-hand side of the screen, you can see that under the Secure Act now, again, it has to be out over a 10-year period. And so if we just assumed evenly taking the money out, which would be about $73,000 a year, and we need to have it exhausted by that 10-year period. Obviously, they've drawn out $711,000 because we've got some earnings on that account. That's why. And you can see that the balance in the IRA is zero. So when you think about it, think about this and a couple of things. One is the $72,000 a year on the left-hand side, or $711 coming out, that was all taxable over 10 years versus $250,000 with $697,000 left. So also to think about this, that beneficiaries that receive money, maybe they're close to retirement. Maybe they have a year or two from retirement. So maybe they hold off on taking any distributions from a beneficial IRA. And maybe in the first or second year of retirement, they don't take Social Security. They delay. They make sure they try to keep their income lower, and they take larger amounts. We just see with the Secure Act really critically important to kind of think through those scenarios and how it's going to happen, because this $500,000, obviously, as I said, this pot of money is a popular place in IRA money, qualified money, where folks are saving for retirement. So Beth, any other additional comments on that?
Well, there's a mantra that I've used for years and years and years, which is the IRS giveth and the IRS taketh away. So the giveth comes with the things that we just looked at, with being able to delay RMD and being able to save into qualified plans or for IRAs longer. And here's the take back of, rather than being able to stretch taxes out over years and years and years, with this provision of the Secure Act, the federal government is going to see bigger lump sums of tax payments coming in. I think this is another planning opportunity, Eric, to your point of timing of when you've got 10 years to take it out. You don't have to take it out all at once up front. You don't have to take it out systematically. You could wait until 9 years and 11 months and take it out. So a planning opportunity to say, where am I at, with regard to retirement or other income coming in, or the need for income, and allowing that tax deferred growth to continue. Or taking it out sooner so you don't have that tax deferred growth. So working with your advisor and planning around these things, if you are going to be the recipient of an inherited IRA, but also on the flip side of it, as far as if you are setting up your estate and your estate plans, of thinking through who the recipients of those dollars are going to be, and where you might want to pay the taxes on these things. For instance, I know we have a question coming in with regard to this, but if you are doing your estate planning and knowing that your assets are going to end up with adult children, maybe somebody who has a large income, maybe it makes sense to convert some traditional IRAs to Roths in your tax bracket, rather than passing a taxable IRA down to the next generation. So it's all in you have time to plan, think about, just not the here and now, but in the future as well. And with regard to the Secure Act and no RMDs, this comes really into play.
Yeah, and that's a good point. Like you said, Beth, we had a question come in that asked, excuse me, does this make more or less advantageous to convert IRAs to Roths? Again, you kind of went through that it could to kind of, if someone currently is in a lower bracket than they think where their beneficiaries will be. We always think about, do we think taxes are going to go up, go down, or stay the same? So and so you think about that, and then any changes to Roth distributions, and the simple answer is no. So we really haven't seen any change as it relates to contributing Roths and the limits there. Converting of Roths, you can convert at any income level, and then distributions are not affected. So you can distribute as long as a Roth IRA has been in existence for 5 years. Then the distributions are tax-free, and they also roll tax-free to the beneficiary. So now, so there's just a lot of planning here to make sure that I think we're about working with our clients. We're about paying the fair share of taxes and no more, and trying to make sure we run these planning scenarios to try to minimize that going forward. We also had another question, Beth, which I think we answered, about annuity inside the 401k. I think we hit that pretty hard, but yep. That really comes to the situation and the cost and what's available there. So, all right. Well, one of the things that was interesting was a little bit is qualified charitable distributions. So if you are over 70 and a half and doing charitable donations, it is advantageous to do what's called a qualified charitable distribution, which is basically instead of you giving money out of your right out of your checkbook, give it out of your IRA. That's the simplest way to think about it. What was interesting was the required minimum distribution age went to 72, but the qualified charitable distribution age did not change. So that's still 70 and a half. And you can do up to $100,000 a year to charities. And the really great thing that Beth and I love is it comes right off your taxes. So it is the best way to give money to charities. Now, if it's $50, probably not worth the processing, but it is the best way. And there still are a lot of folks out there that don't realize you can do it. I just ran across someone recently that was taking required distributions for almost 9 years, was giving to charity and had not known about this available. It is available. The 70 and a half, after 70 and a half, you can start these qualified charitable distributions. And again, it's not tied to your required distributions. You're age 72. Beth, you want to say anything else about that?
Yeah, well, actually, I'm going to challenge you on that $50 scenario, because I do have clients who we have, because I don't want people to feel excluded from this. I have a handful of clients that are giving smaller amounts. Yeah, it's getting the paperwork up and running and everything can be a little bit of a hassle, but once it's in place, it's in place. So there's no, you have the check issued right from your IRA, and it's made payable to the nonprofit, and you don't have to pay taxes on that distribution. The nonprofit gets the contribution to help them in their objectives and missions. and it counts towards your required minimum distribution. So it is a great way. And now with standard deductions being so much higher, people who normally would have given to nonprofits, not only to help the nonprofit with their objectives, but to get the tax break, are finding that they're not able to, or there's no benefit. They're not itemizing their taxes, so they're not able to write off that contribution. Qualified charitable distribution is giving you a tax efficient way to give. And as Eric said a couple of times, if you're over the age of 70 and a half, this is one of those things in the tax code where it's not in the year that you're 70 and a half. You actually have to be 70 and a half in order to take advantage of a QCD. So, you know, mark the calendar, turn 70 and a half on May 17th. Well, you're not going to be able to make your first qualified charitable distribution until May 17th, as an example. So this is a great tool. It's written into the tax code. You know, that changed a handful of years ago. We used to have to wait until the end of the year to see if it would be available or not. So qualified charitable distributions, as I said, they hit three major components: helping a cause that you believe in, meeting your required minimum distribution, and tax-free distribution from the IRA. So it's a great tool. And if you're not familiar with it, if you haven't used it, it's worth looking into, and we can certainly help with that.
Yeah, that's some great points. And yeah, we'll process paperwork for $50. So, and the great thing is that for us is our custodian Schwab that we use, they don't charge, to process. I mean, we have a lot of clients that have multiple, multiple charitable distributions, and getting the paperwork, once you get it set up, it's good to go. So, the other thing I should mention about that, and I think clients know this, but there is no reporting that actually comes from a custodian, Schwab or other custodians, or it does not show up, and it does not show up on your 1099. So when you take a distribution, it's going to show as a distribution. It's up to the taxpayer to actually code that as a qualified charitable distribution. What we do here at Hilltop is we track it, and then we send out a notice, and those notices actually are just going out because of taxes, to let clients know what qualified charitable distributions they did for the year, because you may or may not remember. But just so you know, it doesn't show up. They basically, the IRS has said, look, we're not going to create a form for it. We're not going to create a line. And the custodians say that's not our responsibility, it's the taxpayers. So it's just important to remember, if you did one, that you did a qualified charitable distribution. So, all right. Beth, any closing thoughts that you would have on the Secure Act that you would like to leave with folks this afternoon?
Just to reiterate, the great planning opportunities within here. It enables people to delay and get a couple, 18 more months of tax deferred growth on their investments. And there are components to it not related to retirement. So, digging into it and seeing how these pieces could impact you or somebody in your family, I think it's worth the time to do that, and we're here to help if that's appropriate.
Oh, yeah. Okay. Yeah. Thanks, Beth. And just to kind of curtail on that, every situation really is different. So, I say often you don't want to take, financial advice from the person down the street or a friend, because every situation is different. Tax situation is different, risk tolerance is different, and strategy is different, and what you want to accomplish. And so it really needs to be based on your situation to make sure you're making the right decisions. I will say, with some of the Secure Act changes that come about, mistakes could get more costly, especially for beneficiaries. It could get way more costly. So you definitely need to think about that from that perspective. And I had a question too. I know, and I've had this a couple times. So, everything came into effect January 1st. So I said it in the beginning that if you, turn 70 and a half this year, you're under the 72. If you turned 70 and a half and you did a distribution in 2019, you are under that schedule. You're under the old So you're under that required minimum distribution. Same way upon death. So, you know, if somebody passed away December 28th, they're under the old being able to stretch. If they passed away January 3rd, they're obviously under the beneficiaries under the new 10-year rule if they're a non-spouse beneficiary. So just think about January 1st as a real point there. But if you're a current client, we certainly will be talking about this. As you can imagine, as a team, we've been talking about it already. And thinking it through from a strategy perspective. And in fact, our tools that we use that are very sophisticated tools already have a lot of these things built in to adjust for the legislation. And if you're not a client, we certainly would welcome the opportunity to just have a conversation. And you can go to our website, schedule a 30-minute call. We can find out more about you, and you find out a little bit about how we help folks and guide folks along the way. With that, I will let you go on your Wednesday afternoon. So it was about 44 minutes. Beth and I thought we certainly would do it under an hour. So I will say for the entire team and for Beth, thank you very much. Have a great rest of the week, and we'll see you soon.